Joe Morris with Prime Lending. He's one of the premier lenders in the Valley, and he's going to share with us some information on mortgages.
Be glad to. Thanks for having me, Beth.
So before somebody is even looking at buying a house, what kind of documents do they need first off?
That's a good question, Beth. Most documents are electronically available today, so it's really great. It makes it easier in collecting documents, so they don't have to actually print them out and physically bring them to my office or whatever. But what's important, we're going to look at the main documents are going to be income documents and then asset documents for down payment and paying closing costs and those sort of things. So for your income, what's going to happen, we're going to be looking in the application, we're going to look at your past 2 years under a microscope. And so what happens is if you've had a job you've been on 3 years, we only put one job in. Okay, and so we'll get the income documentation for that. Say it's a W-2 job. We're going to typically ask for the most recent 2 years of W-2s and also the most recent 30 days of pay stubs that have year-to-date figures, because that allows them to compute what's going on. If you're self-employed, that's going to be another story. What they're typically going to ask for is for your most recent 2 years of tax returns. If you're self-employed with a Schedule E, that's going to be in your personal tax returns with a separate schedule for your self-employment business. If you have a corporation or a partnership, they're going to get two sets of documents. They're going to get your personal returns, and then they're going to get the corporate returns to see what flows from one to the other, which it can. If you're self-employed, they typically average the most recent 2 years, unless you have a big drop, and then that's an issue. But anything with income or whatever, you're going to want to talk to a loan officer to see how to set yourself up to basically get the best approval that you can and to actually help you plan. Because if somebody's got a major drop in self-employment income, guess what? They may be having to wait a little bit further. And that's okay, because again, if it's a little drop, it's okay. But the underwriters, if they see self-employment income and it drops a lot, that will make them think, is it going to continue to drop? The same is true if you're actually a commissioned employee. If you were commissioned, a lot of time, that's almost like self-employment. So they're going to want to have 2 years to know what your commission is. And that can be done many times with a VOE, which is a verification of employment, because the W-2 doesn't usually break that out. So sometimes I'll actually get end of year, year-to-date pay stubs from my bars so I can show the difference of what is commission, what has to be averaged, and sometimes there's a base. Sometimes there's all commission. So, but just to let you know, commission is treated more like self-employment, is in that they're going to look at averaging and either a fall off or an increase in that income.
And if somebody has changed jobs and they've been at 3 jobs in 3 years, as long as they're in the same field, as long as they didn't go from a taxi driver to a cook or some great drastic change, that's more important, correct?
That is. In fact, I get that question a lot. I'll have somebody says, well, I've had 3 jobs, I can't get a loan out here. Well, that's not necessarily true. If you're in the same line of work, something similar, then it's not an issue, okay? And that can be broad. Like if you're a laborer someplace and you change the job somewhat and you're paid by the hour, and you change it somewhat to do, but you're still paid by the hour, we can sometimes fit those together so that there's not an issue.
Okay.
One thing also is about overtime. They will want to have a history. Again, you're getting to sort of like commission. So if you have overtime now at a job you started 6 months ago, and you didn't have overtime at a job in the past 2 years or so, there's a good chance they're not going to use that to help you qualify because you don't have a history. Mm-hmm. And they come up with these guidelines because of past history of doing loans so that they know when somebody might go to their boss and say, hey, listen, I'm going to buy a house. Can you give me some overtime? So that's why they look at the history. You can also have a part-time job to add to your income, but you couldn't have had a regular 40-hour-a-week job and then get a part-time job 3 months ago to use that. They actually want you to have a part-time job for 2 years while you have your full-time job to be able to use that income. And that does happen more often than you think that they do.
Interesting.
So we're going to look for a way that we can make the income work for you. And then we'll actually tell you if it will or won't. So that's our job, is to set you in the right direction.
You know, I got started in the accounting industry, and when I had a baby, I took on a part-time job on the weekends at Target. And that was in the old days before we scanned stuff. We had to type in everything that was on the price tag. And the only reason I did that was to be able to pay for diapers, and I got a employee discount for diapers.
Okay.
And so that's all I did was That was my diaper fund.
And
But I had that for 2 years.
And it was worthwhile. And I bet that actually even helped you work a 10 key better.
Yeah.
For anybody that doesn't know what that is, it's a counting machine that we use to have tape rolling and add up numbers.
And when I worked in accounting, I used a key punch, so that really goes back.
It does, and it helps. I used to be able to try to do the 10K. I have an accounting degree, by the way, but I used to try to do a 10K and learn how to do them with both hands.
Oh, wow. That is pretty impressive.
Just so if I was writing, I wouldn't have to put my pencil down to do that. So.
Okay, so we know what documents are going to be needed. We know how the buyer can prepare better, but the buyer really needs to talk to you long before looking at a house. We don't want to have a bad breakup that we go show them a house as a realtor and they, oh, I just love this, I want this. Then they come see you and say, well, I'm sorry, you're either not qualified for that amount or we need to wait 6 months or a year, something, and then they're heartbroken. So we want to avoid that heartbreak.
And that will actually come with getting a pre-approval before you go shopping for a home. Because that way you know how much house you can afford, and you may think you know, and that's fine. But it's going to cover things like down payments, debt to income ratio, and credit. We'll talk about credit in a minute. But I'll go back to the documents on what we're going to need to prove your assets. Because what we're going to look at is your most recent 2 months of bank statements. So you've got your income that we talked about. Then we're going to look at the assets for down payment and closing costs. So we're going to look at typically your most 2 months of bank statements, all pages. They need to see off. It says 1 of 8, send 8. They can't do it with 1 of 7 because that underwriter says, what am I missing? Truly, they do. But they're going to look at money and funds coming in. Generally, your accounts will be filled with money from your job. And over time, you may have a savings account and so forth. But the reason they look at the 2 months is they want to look for undeclared debt. Say you have a monthly payment that you're paying somebody that you can't evaporate from the income. They're going to ask about it. Usually they'll ignore it because it'll be like your Verizon cell phone bill. That's fine. And the reason they don't worry about something like that is you can cut that phone off if you have to. But they're looking for what's actually been committed to debt, that you have a monthly obligation for a length of time. If you had a private note with somebody, which is rare, but you might have that, and they can see it from your bank statements, and they will ask about that. The other thing is for the down payment, it can be a gift. If you do get cash and put the money in the bank, whether it's a gift or not, they don't want to see it coming in because they can't source where it came from. Okay, they don't know. They don't know if somebody just handed you money that you were going to pay them back afterwards or whatever. So if you do get cash and put it in the bank, you need to have that sit there so that we don't see it coming in that statement. That can easily be 2 or 3 statements down the future that we can do a pre-approval based upon that fact. Because things change. I've had people have money in the bank that I could source that car broke down, they had to spend money on it. And they couldn't go forward until something caught up. But yeah, I had one gentleman, he had gold bullion in his safe. Couldn't tie it to him. And he wanted to actually buy a house for his granddaughter. He was going to put 20% down, but we couldn't source the gold to him. There was no way, but he had enough cash because she was in a bad situation. He wanted to take care of his granddaughter immediately, and he couldn't buy the house fast enough. He had a contract, but he couldn't source the money, so he had to pay cash for it and then do something down the road.
Wow.
So they do source those. So that's a little story with that. So they're going to analyze that bank statement to make sure that you don't have strange cash coming in, because they'll ask you to source it if it's cash, any way, shape, or form, or other things. They want to make sure that that money is legitimately tied to you in a way that we can prove it.
So also, if you're looking at having some money come in, you're going to sell a vehicle, you're going to have an inheritance, whatever it is, it's always a good idea to talk to the lender first, because you might be able to give them some advice that'll save them some headache down the road. Sure. When they are ready to buy a house. With
a legitimate sale of an asset, such as a car or so forth, you'll have a bill of sale, you'll be able to prove it. They follow a paper trail. If, like we were talking about, if they inherited some money, they would get that out of the will of that, and there would be a paper trail from the trustee to them. So that's immediately sourced. We just have to support it and prove it. Because everything that's done that's a question, they don't like unanswered questions. They just need to prove it.
Great. So you mentioned Underwriter.
Mhm.
How is the underwriter different from sitting here talking to you? When you're going to get their information, they're only seeing your face
Right.
or talking to you on the phone.
Mhm.
Who is the underwriter, and what does that mean to somebody?
What an underwriter does, and that's a good question, Beth, is they make sure that the loan fits the parameters of whatever the loan is, whether it's FHA or conventional. The lender doesn't make the guidelines. What happens is the GSEs make the guidelines. Fannie Mae makes the guidelines. Ginnie Mae for VA and so forth. They kind of make the guidelines, and they see what's being there. It's where the loan goes to. That we have to meet their guidelines. Now, some lenders may have some what they call gosh, I can't think of that right now. Overlays. They call overlays, which they might have something like. Some lenders won't do double wides, though FHA does double wides and conventional does, but that lender's overlay says we don't do double wides, and they have the right to do that. But yeah, there's a lot that the underwriter's going to look at, and they can't take our words for it. We just have to document it. And what their job is an underwriter, is to protect the lender from doing a bad loan, okay? Because that can be an issue for the lender, for the borrower, because if the borrower gets in a loan that they don't qualify for, there's a good chance that that loan will not perform and they may end up being foreclosed on. And that's a lot harsher to somebody's lifestyle. So the lender's protected by the underwriter, which protects everybody in the system down to the borrower, which is